Hello, everyone. Greetings. Welcome back to Tech Talk. Firstly, would like to thank our sponsors, K Media Marketing, Borneo Post, Utusan Borneo, Sihua Daily, Oriental Daily, the Sunday Post, TFM, um, also AITV, Vipa, Netstairs, Meta Exchange, and Maxwell Rand. Now, today's show, we have got a milestone whereby the official collaboration between Maxwell Rand Inc. and Quantum Valuations. So, congratulations to both teams on forging a paradigm shift collaboration that will redefine how the world approaches intangible assets and M&A strategies. Now, Maxwell Rand, in a strategic collaboration with Quantum, brings a precision focus on unlocking business growth through the combined power of intangible asset valuations and technology-driven M&A strategies in the golden age of AI. In the emerging hybrid economy, where digital platforms, algorithms, and proprietary data often hold more value than physical assets, many organizations still underestimate their true worth. Now, Quantum delivers world-class expertise in identifying, valuing, and monetizing intangible assets such as intellectual property, brand equity, and proprietary know-how. Maxwell Rand complements this with digital asset mastery, AI foresight, and leapfrog technology advantages that position companies to lead in the decade ahead. Together, they empower businesses to recognize, optimize, and monetize hidden value, transforming it into competitive advantage, market leadership, and tangible returns in an economy where AI is the ultimate accelerator. Now, welcome to Tech Talk, where we bring industry leaders together to share insights that shape the future of business, technology, and finance. Introducing Meta Exchange AI Inc., a Nasdaq private market listed company driving AI powered transformation in M&A and strategic investments. Introducing Maxwell Rand Inc., a US headquartered group operating with an 80% AI and 20% outsourced elite human model since 2010. And introducing Quantum Valuations, specialists in global intangible asset valuation and advisory services. Now we have our speakers here, Dr. Ahmad Moradi, CEO of Maxwell Rand Inc., Mr. Tim Heberden, Managing Principal for Valuations at Quantum Valuations, and Mr. Ian Lim, Director for Valuations at Quantum Valuations. Now, we have got three segments here today. Segment one, whereby we will be talking about understanding intangible asset valuations. And there are questions that will be directed to Mr. Tim and Mr. Ian Lim. So, gentlemen, kindly introduce yourselves before I start the show with the questions.
Great, I'm happy to jump in. So Tim Heberden, yes, I've been valuing intangible assets and businesses reliant on intangible assets for more than 25 years. So it's my passion, and I'm delighted with this collaboration. So over to you, Ian.
Yep. So my name is Ian. I'm a chartered accountant. Spent over the last 12 years across financial audit, M&A, and valuations. And I specialize in intangible asset as well as IP valuations, helping clients understand the true commercial value of how these assets contribute to their overall business performance.
Over to you, Dr. Moradi.
Greetings, everyone. Thank you for being with us. It's a pleasure to join and have a esteemed colleague from across the world. Our goal and objective is always to create content that it can help our colleagues and our stakeholders under the new parameter, what we call ESG model or SDG model by United Nations. And one of the areas that we feel that is extremely important as Maxwell Rand, we've been doing investment banking, acquisitions, IPO, LBOs, reverse, but mostly wealth management is part of the whole strategy. So therefore, we are delighted to have our esteemed colleague from Quantum in here because the subject matter is extremely valuable since the bankers throughout what we call from the 70s until recently, they would only entertain what we call tangible assets. So when you wanted to go to the bank, for example, you could borrow against your tangible assets, but not in intangible assets. And private equity and those kind of markets are a new paradigm shift. And that is why we have our colleagues in here to start explaining. Back to you, Mr. Vijay.
Thank you, Dr. Muradi. Excellent, gentlemen. So, Tim and Ian, now here's a question that is directed to both of you all. What exactly are intangible assets in today's innovation-driven economy, and why do they now make up most of corporate value?
Thank you for the question, Vijay. So if we start with the formal definition under accounting standards, which is IAS 38, it describes intangible assets as identifiable non-monetary assets without a physical substance. And if you look at the international valuation standards, it puts it more plainly by describing these assets as assets that don't have a physical form, but they grant rights and economic benefits to their owner. Now, that's the technical definition, but in practical terms, what does it mean? It means the things you can't touch, but which increasingly define a company's competitiveness. So things such as your patents, your software, your algorithms, your brand, data, relationships, trade secrets, and know-how. And now here's what's remarkable. So over the last half century, the very foundation of business value has flipped. In 1975, intangible assets made up approximately 17% of total business value. But by 2020, that number has surged to around 90%, and it has stayed there ever since, according to a well-known Ocean Tomo study. Now, to put that in dollar terms, just 3 decades ago, the global value of intangibles is approximately 8 trillion US dollars. And today, it's over 80 trillion. So that's not just a statistic, it is a measurable shift in what truly drives business value worldwide. And this isn't just happening in Silicon Valley or New York, but across the USA, Europe, Australasia, Southeast Asia, the same trend holds, and anywhere between 50 to 90% of enterprise value is now comprised of intangible assets. And why is that? Because in today's economy, competitive advantage isn't built on your machineries, your real estate, factories, or your fleet of trucks. It's built on ideas, innovation, and information. But here's where it gets interesting. Not all industries lean on the same intangibles. You'll find that in different industries, some intangible assets are more valuable than others. But what differs is their relative importance, the momentum of the categories of intangible assets in driving business growth, and the integrated contribution of these intangibles. So to give you an example, in pharmaceutical and biotech, patents and R&D are the king assets. In technology space, software, your data and algorithms, these are your core drivers. Whereas in luxury goods and consumer brands, reputation and branding often matter more than the physical product itself. And yet, under the current accounting rules, we only see a fraction of this value show up on the balance sheet. The current standards only allow for recognition if the intangible asset has been acquired. For instance, if you're buying a patent, or if you're licensing an IP, or acquiring a brand in an M&A deal. Some R&D expenses can be capitalized, but most internally generated value, such as your in-house brand, your culture, your customer loyalty, these cannot be recognized at all. That's why you can have two businesses with the same balance sheet assets, but wildly different market values, because one is driven by intangible asset strength that accounting simply doesn't capture. And what this means for companies is that they are leaving value unmeasured, they are leaving it on the table, and it represents a strategic blind spot. And that leads to undervaluation in your fundraising, in your M&A negotiations, and even board level strategic decisions. So in short, in today's economy, it is no longer about these physical assets, it's about the intangible assets that you own.
Thank you, Ian. Now that was very eye-opening. We had a similar. I run a corporation here in Malaysia. So 10 years ago, taking in the intangible asset into the account was a nightmare. But so I understand, and at least now we have got the measuring matrices to get that done. Now, how does Quantum's methodology adapt to complex global IP portfolios?
I'll do this one. Ian's done such a great job on the first question. I guess, Vijay, the first component, you mentioned the word complex, and there's no denying that IP assets of all intangibles are very complex. And that's one of the reasons that there can be big differences in valuations between the findings of a specialist valuer of IP assets as opposed to a business valuer who just occasionally dabbles in IP valuation. And it's not so much the methodologies that differ, but the way in that which they're applied. So Damodaran, the great valuer, describes valuation as a craft. So it's not a science, it's not an art, it's a craft. But you have to have the tools, but you have to learn and understand how to apply those tools and when which tool is appropriate. And I think the first thing I'd say is that at quantum valuations, we don't dive into the number crunching. We first make sure that we understand the mechanics of the business. We always think about the cogs in a business model, like the old cogs in a watch or a machine. Some are big, some are small, they fit together. In this instance, they're driving cash flows. But as Ian said, in different industries, you can have very different cogs and different sizes. And even in the same industry, depending on the strategy, depending on the competitive advantage, you can have a different kind of mechanism. So the first thing is we understand, we call it intangible value mapping to identify how the business works. And then once we've identified those most important cogs, we do a deep dive asset assessment, which is a kind of full spectrum assessment. So again, financial analysis is part of that, but unless you understand the technical and the financial characteristics of a technology asset or a data platform or a brand, you can't do the right number crunching. So the value mapping, the asset assessment, and then we feed those insights into a valuation model. And it's not just that gives us confidence in the output. It also means that valuation report is a coherent commercial document, which if a banker reads it, or if a financial person reads it, or whoever it is, it kind of makes sense. We're showing the building blocks in the value. We're not pretending it's an exact science, but we have the confidence to substantiate our assumptions and to cross-check our findings. And perhaps the last point I'll make is you mentioned global markets, and it's another characteristic of IP and its complications. They typically vary by jurisdiction. So you might be valuing a technology, and in one market it consists of patents with broad claims and trade secrets and copyright and software code. In another jurisdiction, there are no patents. It's a different asset, even although it's meant to be, or it is doing the same thing. So that's a nutshell version, but just saying it has to be a thorough, meticulous, and honest process to make sure that there's credibility attached to the findings.
I have a question from Mr. Lim. From the accounting perspective, when you're doing the valuation on a global scale, one of the key elements is always the transparency and building the report that it can become applicable both under PCOAB standards in United States and under PCO or PCA of your region with the IFRS accounting. In this kind of a translation, how does this asset, once it's identified and has been established, could become the key element of the transparency between these two accounting strategies that we deal with on a constant basis, Mr. Lim?
Right. So I think generally, just to reiterate, under the current accounting rules, only intangible assets that are acquired would be available for recognition on the balance sheet. So things like buying a patent, licensing IP, or acquiring a brand in an M&A deal. And for certain internally generated intangible assets, they might be subjected to additional accounting recognition rules, such as identifiability. Can these assets be identifiable? Can these assets be separable? And of course, are they able to generate economic benefits, which you can reliably measure? So in the accounting standards, there is a very a structure in which an intangible asset has to be assessed collectively, whether it meets each of these criteria before it is available for recognition. So, and this applies not just for PCA or AOB audits, because in general, under IFRS 38 or the International Financial Reporting Standards, the same recognition criteria applies to all intangible assets. And of course, the regulatory authorities are constantly looking to improve on the standards, and who knows, maybe in future there might be further developments in terms of the standards, and which allows for more recognition of certain assets.
Correct. I have a question for you, Tim. In the process of recognizing these intangible assets, I was meeting, for example, with Raymond James Group, and they suggest that entrepreneurs and the companies, especially private companies, to establish a checklist of items for their assets, intangible assets. How would you go about interviewing and identifying a potential client that they are coming to you for the valuation? Let's say, I understand the diversity of the industry from biopharma all the way to the technology. But could you educate us a little bit and tell us how the stage gets set up so these people can prepare themselves for that valuation, if you will?
Yes, sure. So we'd call it an intangible asset discovery process. And it's a very good point, because you'd have thought it's pretty obvious a company should know what assets it's got. But it's typically, even in well-managed companies, they have very poor visibility of their intangible assets. So firstly, there's some easy parts. So registered IP, patents and trademarks, it's very easy to ask for a list, and you'll get a list of that. You can ask what sort of processes there are for trade secrets and how they're protected. You won't get a list of that because they're secret, but you'll get to understand kind of what's in the box. But we also find it's this value mapping process. We've got a range of different questions where we'll start off with fairly broad commercial asset categories, whether we're looking at software, whether we're looking at manufacturing technology, whether we're looking at databases and so on. And you mentioned interviews. We will have interviews, but with a range of different stakeholders. We'll have it with the kind of tech and R&D department. We'll talk to salespeople. We'll talk to operations people. And it's having those right questions underneath the asset categories that you start getting visibility. So, I spoke about those cogs. You start off often and there's kind of a bit of a blank thing. You've got, we've got some computers and we've got some plant and equipment, and we think that's brand. But as you start going through that interview process, they start coming into sight, and that's when you go into the deeper layers, to get to understand those kind of legal and technical capabilities. So a checklist's a good idea, but quite often you need a little more of a systematic kind of asset-based framework.
Correct.
To ask the right questions in a layered fashion.
Especially related to that industry, I presume.
Yes, correct.
Okay, great. Back to you, Mr. Vijay. Sorry.
Thank you very much. Now that was very, very insightful, because now we have got an asset that we can't see, we can't touch, and we got value to it, and very nicely put by Tim. You got cogs now that you need to identify with the checklist. Very brilliantly said, gentlemen. Now, can you share a success story where accurate valuation changed the trajectory of a deal or a company growth?
Yes, well, one that comes to mind, I get asked this question sometimes, and I try and mix them up so that I don't get bored in the stories. But the one that's top of mind at the moment, I'll go into, and I think, just sort of rephrasing your question a little bit, it's not just the results of the valuation, but it's that kind of support of the deep understanding of the assets together with the valuation that really gets
complementing each other, right?
Yes, you can have the same number, but
Right.
one number people will say, get out of here, I don't believe that number.
Right.
Whereas
Right.
the other one will make sense because they can see that you factored in the risk and the characteristics of
Right.
the asset. But the example comes to mind is a company that had invented an item of industrial equipment, and this was in a market that had been stagnant for 20 years or more. Same old equipment had been used and everyone just thought that the way it was. So this was potentially disruptive. Now, it was pre-revenue. They developed a prototype, and the good news was that that prototype had been subject to pretty extensive testing, both safety testing, being electrical equipment, but also performance testing. The other thing is that the business owner had a corporate background. He was a good player. He presented a very solid business plan and a well-constructed financial model. But despite that, they just weren't getting any traction with sophisticated investors. You've probably heard the story before. They wanted market validation.
Right.
They almost wanted the upside potential of the risk, but then without the risk.
They want to be the second first.
Yes, exactly. That's a great way of phrasing it. And we used, so we've got a quantum technology grading tool. This was an earlier version of that, and it provides a kind of 360-degree assessment of the technology. And as we started doing that, we discovered that there's already plenty of good information in the data room. It just hadn't been well integrated and perhaps hadn't been subject to the extra layer of analysis. So if you just picture a little radar chart now, where you've got a whole range of performance and safety characteristics, an independent benchmarking of this new innovative technology against the same old industry standard. And against every single one of those measures, there was a significant uplift. And, that data was there, but it had never been presented in that way. So we pulled that together as part of our grading process, and then spent time with a patent attorney. That technology had 13 patent families, multiple jurisdictions.
Right.
And we worked out what technical features gave rise to those performance and safety benefits, and then went a step further back and said, are those technical features protected by claims of the patent? And the good news was they were. So, that's obviously a key thing, because you might have
validation, yes.
But yes, and if your technology is not, if the important components aren't protected, someone else is going to enjoy the benefits. So ultimately the fact that we'd established that there was A-grade technology, you were able to feed that into the valuation model and into the report to substantiate the assumption. So the assumed market penetration suddenly made sense when you understood the benefits, and the pricing policy was at parity with the inferior technology. So, step by step, the assumptions in the cash flow forecast, we were able to get comfortable with and give the reader comfort of, and then also make sure that our risk wasn't just, it's a pre-revenue, we're going to slam on a 99% discount rate.
Right.
It was a rate that reflected the risk, but wasn't excessively conservative. So, in that, as soon as that report went through, it kind of changed the mindset. They got traction with the investors. They got the funding in at the top end of their expectations. So that was more, it gained traction. It got the funding. We do have other examples where you might suddenly have a doubling of a revenue multiple or something. But I think that profound binary, not interested to yes, I'll invest is almost more profound.
Tim, I have a question about the same thing that you're bringing, because companies go through different phases, as you know, from pre-seed all the way to maturity and expansion and IPO. How often would you suggest that the company should reevaluate their own valuation as they're going through these phases, in your opinion?
I think the most important thing is to have a well-constructed valuation model and a good understanding of the value drivers and those kind of pivotal assumptions where you just can't be certain about. And then depending how the outcome kind of shifts, depending on those key assumptions, that will probably influence how regularly you'll have to come back to it. But it might even more importantly say, you really need to go away and get more evidence on that particular assumption, whether it's a technical function or a pricing function or a production cost function. But once you work those out, we would typically say they're going to be kind of key metrics, key performance indicators that you'll want to be tracking regularly. It might be every month, but the actual valuation you probably won't have to update as regularly. It might be quarterly if you're going through, quite a, development hurdles or so on. It might be something 6 monthly or less if you're not in such a volatile period.
So that methodology that you just brought up will have a profound impact on their valuation as they're growing and expanding their business model. Am I making the right assumption?
It will. And another point actually is what can be really useful is to almost cast yourself into the future. Let's say when you're wanting to IPO or when you're wanting to do another round, but then backfill, and there'll be various decision points. If you think of a decision tree, and at each of those decision trees, companies are making trade-offs because they have to. They've only got so much time, so many people, so much cash. But they're often making those without understanding the value implications. So if you have that model, you can make that decision and say, well, I'm not going to protect my technology in such and such a market. It's too expensive. But when you're making that decision, you should know at the next decision point that might have 100 million reduction in your value. So it just gives you the ability to understand the value or the probable value implications, the order of magnitude at least.
So it's not as simple as going to ChatGPT and say, I wrote the software, how much is it worth, right?
Yeah, that's easy to do. I'm not sure if you're going to have a happy finish with that.
Back to you, Mr. Vijay.
Yeah, that is very interesting to know that you actually track the valuations monthly or quarterly. Now, this gives a lot of comfort to the person who's going to finance the transaction or the asset or the company that acquires the asset. Now, that's interesting part of it. Now, how do you ensure valuations are defensible and respected across jurisdiction?
Okay, I'll take this question. So when we talk about valuations being defensible and respected, we are really talking about three things: the methodology we are applying, the frameworks that we anchor to, as well as the credibility of the professionals applying them. So on methodology, we follow globally accepted valuation approaches, such as your income approach, using discounted cash flow methods, the market approach, using trading or transaction multiples, the cost approach, looking at the replacement or reproduction value of an asset. And then on frameworks, we ensure alignment with international standards. For example, in Australia, we apply what we call APES 225, or the Accounting Professional and Ethical Standards Board Professional Standard for Valuation Services. This is the authoritative framework for valuation practitioners in Australia. In the US, we regularly encounter the Internal Revenue Code Section 409A, which requires independent valuations of private company shares to support compliance. Meanwhile, in Singapore, the UK, much of Europe, valuations are prepared under the International Valuation Standards published by the International Valuation Standards Council. And locally in Singapore, we have the Institute of Valuers and Appraisers, or IVAS, which enforces IVS to ensure high quality and consistent practices. But beyond that, there are other professional bodies such as the American Society of Appraisers, the Royal Institution of Chartered Surveyors, that also provide accreditation and guidance to practitioners to reinforce consistency and credibility. And we have to tailor our approach to each and every jurisdiction, whether that means APES 225 for Australia, 409A compliance in USA, IVS for Singapore and Europe. We need to ensure our valuations can stand up to scrutiny from regulators, auditors, investors, and even tax authorities. And valuation is not just about running numbers, it's also about who is standing behind those numbers. And at Quantum, our valuations are led by senior practitioners with deep technical expertise and experience across these types of valuations. So I think these are the three most important elements: the methodology we use, the frameworks we anchor to, as well as the credibility of the professionals behind these valuations.
Thank you, Ian. That was very well said. So we have now at least understood the rise of intangible assets as the primary drivers of enterprise value, the risk of undervaluation in M&A and investments. Now, how do we look at that? The risks of undervaluation in an M&A and investment outlook.
Who are you asking?
Either one of them can answer.
Okay. That's kind. I wasn't sure if you're looking
Right.
for the valuation practitioners. I can have a go at that. So I guess the important thing, if you're the company owner and you're looking to do an IPO or any sort of deal, the risk is that much higher if you're underprepared. So it gets back to the points we've made about really being able to document and provide the evidence that supports the upside potential or the earnings potential, so that it's not just hope value, it's substantiated value. The other point I would make actually is we do sometimes find where the clients themselves have undervalued the business. And that it gets back to the complexity of some IP assets, and their current use of an asset might not actually capture its full value. That whole concept of best owner is kind of on steroids with IP assets. So sometimes we find in a transaction preparation process, they're actually underutilizing the assets, and there might be licensing opportunities or other opportunities. Those other aspects of IP economics, the scalability and the monopoly rights and so on, I think are quite well understood. But it's making sure that you understand your own assets and then you communicate that effectively to whoever's on the other side of the table.
Thank you very much, Tim. Now, gentlemen, let's go to our segment 2, M&A strategies in the AI era. Now, these questions are directed to Dr. Moradi, and if both you gentlemen want to chip in, it will be more than welcome. Dr. Moradi, what are the major global trends driving M&A activity today?
Well, there are different regions with different kind of demographics and different kind of needs. For instance, in the United States, we have a generation of what we call baby boomers. The baby boomers constitute a lot of small businesses that now their children have become a professional, a doctor, an attorney, or something, and they don't want to run mom and dad's restaurant, for example, or the food business, or any of these kind of things. So M&A has become very substantial in the United States, where mid-sized companies are acquiring small businesses, and then they create their portfolio. Then ultimately they sell it to larger institutions. And that has become part of this trend that is also taking place. But in Europe, for example, this M&A is more localized because of the geo-IP of every country within EU, their culture, their diversity, and how they look at small businesses, and also the generation of the families that they run the businesses in that kind of a context. But more importantly, the area that you have to look at it is from the location of the trends that now it's getting infused through artificial intelligence. So there is a lot of systematic protocols, new standards, new analogies, new what if then else business intelligence researchers that are coming together now, allowing valuation to have a different perspective, if you will, for the M&A. But ultimately, that becomes a transactional procedure. And I normally, when I talk about M&A myself, being active in this process, I want to make sure that I'm working with the people that they have the right chemistry, so we don't get into a friction. Okay, and then they understand that our intention, with our vision, mission, goals, and objectives are directed toward the success of a result. That result becomes, like Tim just mentioned, a pre-IPO or an IPO stage for the company, because without those valuation, you cannot go to the street these days. Under the law of solicitation, there is a lot of requirements that people forget about it. So even if they go to their mother-in-law and ask for money, they are soliciting. So it is best and safe that we recommend, and that's one of the reasons we are working with colleagues like yourself at Quantum to educate the market that if you decide to go and raise money, uh, provide yourself with the proper tools through your data room, technologies, the right valuation, and your pro forma becomes a good indicator, especially if you're at the pre-seed or pre-revenue, that it shows that how you're going to maximize that. Think of a day, for example, Uber, right? They have no assets, they only have software, or Airbnb, where actually the gentleman who started it, he was a software engineer himself, right? And he couldn't pay the rent in San Francisco. So he started renting his rooms to our colleagues because he had to cover the rent. And then he observed that as a problem. And he says, well, I think there are other people who may have this kind of problem. And ultimately now you have Airbnb, right? So this kind of venue always starts from an area where without those valuation, he would not be able to get there. So that is extremely valuable asset that you have to look at your own company. But there are more important things, and that is one of the things I wanted to ask Mr. Lim again. A lot of companies these days, they go into what we call a bootstrapping model, for example, because of their limited cash flow, their business model, and so forth. And they go and pick up some API, if you will, from a third-party software, and then they mix them up together and they create a new recipe. How do you make that kind of evaluation a justifiable valuation? Do you go by the method or do you go by the IP? How do you mix that together?
So I think in terms of approach, at the end of the day, we look at the contextual circumstances of those assets,
Mm-hmm.
strategy in driving growth and value for the business.
Mm-hmm.
So when we are looking at the asset, for instance, if you're valuing, as you mentioned, a platform, that platform could be underpinned by not just a single asset, it could be underpinned by the know-how, it could be underpinned by the software, the data, and there are a multitude of other assets that work synergistically to contribute to that overall business performance. So when for as valuation practitioners, we apply judgment in choosing the right methods
Right.
based on the circumstances, and how the management plans to utilize the asset and monetize the assets. So, for instance, if we are looking to value a very early stage technology asset, for instance,
Right.
we also need to understand what stage of that technology asset it is currently at, and of course, how much more hurdles it has to go through to completion. When is the initial year of when is it expected to start commercializing and generating cash flows for the business? And then that aids us in and guides us in choosing the right methodologies. In this case, an income approach method is typically applied when there are available financial forecasts, when you're able to determine financial forecasts as well as the underlying unit economics and assumptions reliably. And in certain instances where there are less or where very hazy information as to how to determine such forecasts and where they are not available, then we have to resort to other alternatives, just as a cost method, where we looked at what does it cost to replicate the functionality of the asset today, or to replace the asset today in an entirety. So as valuers, we have to exercise flexibility in applying the appropriate methodologies and also do appropriate cross checks to ensure that our valuation outcome is robust and defensible.
Thank you.
If I could, Ahmed, because it's such an interesting kind of question.
Sure.
But, there are situations where, you can't kid yourself that there's a single scenario or narrow valuation range, which is the output. So sometimes, as Ian said, we'll triangulate, we'll use different valuation methods and try and narrow it down. But one does have to recognize in some instances that there's a broader range of possibilities or a broader range of scenarios. Obviously, as a valuer, you can't just say it could be between, floor and ceiling. That's no use. Right. That's no use to anyone. But at the same time, you can't perhaps come up with a misleading level of precision without recognizing that's the most likely scenario, and maybe we're giving it a higher weighting. But there are other scenarios that could eventuate that are less likely.
Got you. So in a layman's term, for our simplicity, let's say a grandma's recipe versus Coke recipe, right? Yes. We both have ingredients published, but one is safe and grandma's recipe is secret. How do you go about somebody like that says, hey, I got these best ideas and best recipes and I want to do a valuation? How do we go about it?
So those kind of formulations and recipes are interesting. I mean, often they are, once they've acquired value, they're going hand in hand with the brand, and again, obviously Coca-Cola, the brand is enormously powerful. But yes, obviously you've got the trade secret there as well. Ian did mention the the replacement cost. There are sort of some formulations where there might not be so much magic in the difference. It might be possible to have one which on blind tasting no one would notice the difference. So yes, you'd love Grandma's because that's got all of the association, but that's a brand thing. It's not a kind of taste thing. So then we're valuing the brand rather than the recipe. But I guess what I'm saying is it's really the uniqueness of that. Whether or not you can kind of reverse engineer, because some you could, take Grandma's recipe and send it off to the lab and maybe get a better understanding of what's in it. But that's maybe a bit of a garbled answer. But I guess it's getting back to Ian's point earlier. It depends on the circumstances. It depends on kind of how special and hard to replicate that recipe is.
Taking that into an account, then would you recommend somebody like got the Grandma's recipe? I'm using this as a use case again for the purpose of simplification, that they should retain a legal counsel and try to get a trademark, copyrights on the recipe so they can protect their asset before they come to the valuation. Is that something that you would encourage them to do?
It does depend on the asset. So the recipe, no, what we'd say is guard it, treat it as a trade secret, kind of don't tell it to anyone other than who you have to. And even sometimes people will have in more elaborate recipes, they'll have different teams working on different parts of the production so that no one knows the full recipe. They all know little bits. In terms of other protections, so yes, we would recommend that you have a brand attached to that special recipe. And then we would definitely recommend that you get trademark protection and trademark advice for that brand. That's not very expensive, so that's okay. But yes, having registered IP is sometimes very useful and essential. Other times, it's not the answer.
So that would impact definitely the valuation based on protection that the entrepreneur is bringing to you. Just instead of bringing a shoebox and it says, hey, I got these kind of things and I want you to do a valuation for me, right?
Yes, it does. And sometimes when we're doing that discovery process, we'll say, look, if you're not running out of cash right now, rather go away and fix these things up.
Correct.
And then we'll do the valuation in 6 months. But at least we'll give them the framework then to say where the Achilles heel is or the gaps in their sort of intangible storyboard.
So, Mr. Vijay, to get back regarding the M&A, for a company to come over to become qualified, for us is extremely important that they can have their, depending on their stage, but in our requirement on Maxwell Rand, we require at least 2 years of audited financial statements. We require valuation that can be done by Quantum, because that presents the projected value along with the pro forma, that when we are talking to the investment community and raise capital or go to the pre-IPO or IPO stage, the authorities can officially sign off and back the company with its growth strategy. Back to you, Mr. Vijay.
Thank you, Dr. Moradi. Now, how do intangible assets influence acquisition strategy, deal structure, and post-merger performance?
Well, the intangible assets normally prior to this, and I think if I'm not mistaken, they would have a line item in the balance sheet that it basically has very maybe by cost accounting, or it has been expensed out originally because like R&D, that it would impact the projection. With the valuation, you're shifting that paradox from the expense to assets now. And this is extremely valuable and important for the companies that they are positioning themselves either to go raise capital or go into an IPO strategy or go into M&A, any of these other variables. And Mr. Lim, you can probably back me up, or if I'm wrong on that kind of side of the equation, most of these companies that they go and do their outsourcing, if you will, and they build their IPs and they have expensed it out already. And now they come back to you and they say, well, you know, we spent X amount of dollars and we developed this software, for example, and now we are ready to go to the market. How do you advise them to basically proceed with that valuation to transform that expense into the asset that it can impact their valuation?
Thank you. So I think essentially it requires understanding at what stage are those assets currently in development, how much longer it would take till completion, and of course, how does it start generating the first dollar to the company. So I think, as you rightly put, these are all important factors to consider. And intangible value is not static, it's highly contextual. It's always at a point in time. So as valuation practitioners, we value it as it is, as a point in time. But we are allowed to consider its commercialization potential, to which case we can then apply scenario-based valuations and calculations. This can help the buyer and seller understand not just what the asset is worth today, but how the value might shift depending on an integration in the current business model, or maybe an improvement in market adoption, or even market management's execution over time. So it's also about understanding the value dynamics in this process, and that's how we typically assess it.
Thank you. Tim, in your opinion, where does digital assets fall into the valuation?
Well, increasingly, I suppose, for a lot of organizations. So perhaps now, rather than talking about the the next unicorn or the startup, this one also gets established companies suddenly with digital assets, which might be significantly changing their efficiency, their effectiveness, kind of their earning streams and their value. So they kind of come in, I suppose, in many different types of organizations, very different situations, and also perhaps different capabilities in terms of understanding their worth. If you have a company that's whole essence is around the creation and monetization of digital assets, the decision makers get that. But if you have, let's say, an innovative team in a big corporate who creating some digital assets, they might battle to get traction and might battle to kind of get the support from senior management who are used to old style assets. So
do you think they are intertwined between intangible asset and digital asset, or do you see them as a separate line item in your valuation?
We'd see it intertwined.
Okay, great. I'm clear. Mr. Vijay, back to you.
Thank you. Now, Dr. Moradi, Maxwell Ren has got Max AI is our proprietary AI. Now, how does Maxwell Ren's AI first approach enhance M&A speed and precision?
Well, I've been an AI student from 1986. So, being in the stratosphere of artificial intelligence for decades, it is part of my DNA. I always try to look at how we can utilize AI as a tool. But now, in today's market, we are in the golden age of AI, and there are a variety of formats, algorithms, methodologies are coming together that it makes the industry extremely interesting. The future shift of investors are culmination of using methodologies and algorithms. For instance, right now we are working with a group out in Netherlands. And one of the areas that we are working with their scientists in the AI is the fact that they come up with a business plan. And now you want to evaluate the business plan and look at those requirements. But then you'll see, few pitch decks, a few slides, and you want to make a determination. And you really cannot, because one of the ways right now we are putting a campaign in Netherlands together where we are encouraging the European entrepreneurs, especially under, as you know, Europe is more and heavily regulated than United States in those kind of structure. We can have the AI to do the screening and read the business plan, for example, find out the points and understand what we are missing, what we have, what we don't have. And then we can point that out to the decision maker and then say, look, these are the things that you don't have. Example of that is valuation. And that is one of the reasons we are honored to work with through Maxwell and with Quantum, because we have to keep the state separate. And we have to keep that independence, that when these comments and reports are delivered to those clients as entrepreneurs or business owners and so forth, it stands on its own ground. It is not influenced by third party. So therefore, this sanctity that we are creating right now, it creates the precedence of understanding the working models between human and AI agents, for a better lack of a term, and then encourage and teach the AI agents, like we have done with Max AI, that it can point out those weak points, help them out to fill in those blanks, take their strength and build out their valuation, like we are talking in here, and then position the company for the next stage. Back to you, Mr. Richard.
Thank you, Dr. Moradi. Now that was very insightful. Now we know that AI is doing a lot more than LLMs. Now, what future shifts should investors and corporates prepare for in the next 3 to 5 years? Now, this is an open question, anyone can answer.
In my view, the companies, there are too many deals all going around. Okay, then you have what we call Main Street and you got Wall Street. Main Street are small businesses that they're running their day-to-day operations and they're trying to build, and a lot of them don't even know about wealth management or about valuation and this kind of services that it's available to their businesses, that they can make it ready when they want to do exit strategy, for example. Like I said, in United States, when we are dealing with the baby boomers and the small businesses, they are not as organized as you anticipate. And that's one of the reasons we decided as an entity only work with NASDAQ private market, because things become regulated, structured, and has meeting and compliance and regulation. And when the company wants to pull the trigger and go up, then it only takes, after filing with SEC and going quiet period, 3 months to become a NASDAQ listed primary market company. And this is ultimately where wealth management gets realized, which we will have a session in collaboration with our colleagues and some of our future invitees that they're going to come to this program and talk about this aspect, that how valuation and wealth management can connect together, because they are pretty much becoming like a yin and a yang, if you will. And then digital assets, along with the physical assets, now is becoming personal portfolio. So suppose I was working as an employee of a company and I have stock options, right? my stock options and my valuations and the company's valuation, they all have a direct connectivity, right, to my personal wealth. But if it is not managed properly and not having that valuation for that company, then the numbers that I'm working as an employee for the company is going to have a direct impact in my personal wealth. And smaller companies don't have, unfortunately, all of those tools and technologies that publicly traded companies do, because they all compete for the same human resource. And now, as an employee, I need to decide, do I want to work with a private company or a public company that gives me more incentives, more of this valuation? So we see the trend are happening more with the private equity now versus public entity. And as this tariff have taken over right now within the United States and has a global impact, the market has become extremely uncertain, because there are days that we lose 1,000 points and the next day we get 1,000 points up. So it's extremely volatile. And taking that into a consideration, private companies that they are planning to go into this kind of growth strategies, what we call is, as a part of that requirement, and again repeat that, make sure you got your accounting done, okay, with the proper audits, especially where those countries like Singapore is regulated. You must have audited financial, otherwise you cannot operate, which makes compliance much easier. But definitely add your valuation to the equation and pack it with your pro forma so they all can come together and give a proper way for the company to negotiate for their M&A or IPO or pre-IPO or any other fundraising stage that they deem necessary. Back to you.
Thank you, Dr. Moradi. Now, we have got a few talking points here, which is open to the floor. We have got competition for innovation-led assets, right? Now, how would this affect valuation? Now, will there be a profound impact on valuations, because you've got innovation assets coming, a dime a dozen every day. Everybody comes up with an asset, right? Now, would it be a profound competition? Sorry, would it be a profound valuation for the valuers, gentlemen?
I can have a first stab at that. I guess there's always a balance of power in any sort of negotiation between buyer and seller. And yes, you do get kind of bursts where a particular asset category is in demand or popular, and you can get bubbles. But I think what you typically find is it doesn't take investors long to work out that there's a particular curve, I suppose, in different areas in terms of kind of what portion of the companies in that space are going to be success stories, which are sort of maybe, and which are very unlikely to. But once again, it gets back to that kind of understanding of those. And whichever phase of the cycle, whether you're flavor of the month asset or whether you're an asset where they're more buyers than sellers, it's that ability to communicate what you've got. And if what you've got is intangible, you've really got to paint that picture well and make sure, the old saying, value is in the eye of the beholder. But it's your duty to present yourself as well as possible, so that whoever's on the other side appreciates the value of what you've got.
Thank you, Tim. That sort of answered, and it sort of fills in our blanks. Now, AI-powered due diligence and deal sourcing. Now, how do you all feel towards AI being used in these portfolios as valuers? Do you all extensively? Are you for it? Are you against it? Or how do you feel towards this AI-powered due diligence and deal sourcing?
Well, I guess it's inevitable. Ian, you might want to go, but I feel a bit hesitant to talk about AI in Dr. Morodi's presence. He's got a good few decades start.
Well, there are institutions in United States that they have taken a stab at it. Companies like Carta, companies like Equivest, that they are pretty much have done over 20,000 valuations, and they have gone through what we call muster tests, like with SEC, with the bankers, with the financial authorities, because they had to get funded. So this kind of things is a gradual process. But I believe the combination of human and AI agent is going to become the power pack. But at the end of the day, you need sign off. Okay, you cannot have the AI to say, okay, I sign off on this, because there is not going to be any approval by the third parties. So that validation, that's one of the reasons that Maxwell Rand is honored and happy to work with Quantum, because that sign off has to come from that source of authorities. So AI becomes only an intermediate tool as a technology that proves and provides and obtains the information for the checklist. And then you use that checklist to create the variables and the missing variables, so the management can become more effective and more focused without wasting valuable time. Those are the suggestions that I may have in terms of what you asked, Mr. Vijay.
Thank you, Dr. Moradi. Now, at least we know that AI can be used 80% of the way to get things done faster. And now the human comes in, and where quantum comes in to add the touch of the validation and the
It depends. Sometimes becomes 2080. You can't really put a number on it right now, because market is in the state of flux. We are just getting our hands down and dirty with the AI, and everybody's trying to come up with the perfect Barbie, call it, whether it's ChatGPT or OpenAI or Gemini or any other engines that they're coming in here. I call them the three wise men. Okay, so normally you try to ask the right questions, and you probably get three different sets of answers actually from them. And then the decision maker has to become the human. If the human is not the decision maker, and you're only relying on AI to put those algorithmic answers for you, there is a lot of knowledge that has already published that AI tends to make it up. Okay, so if it makes it up, then how do you know how the valuation is? In AI, one of the things that we always talk about is called certainty factor. Okay, as an expert, when you make decisions, you're either 100% sure or 0% and somewhere in between. And then you have to find out your deductive reasoning. That reasoning comes out from that kind of thing that right now AI is not there. But the management and the people that are behind the report, like Quantum, then they can give you the reason for all of those variables that they have decided. And that makes a big difference between a good valuation or a cooked AI version.
Thank you, Dr. Moradi. Now, that's a deep insight. Thank you very much. Now, strategic integration of valuation insights into negotiation. Now, how does that work? Now, would that be a good thing or a bad thing?
Who are you asking?
It's open to the floor.
Well, Tim, you want to go at it?
Yeah, so I guess the important thing is that those strategic insights can really shift a negotiation, and they can influence the balance of power, assuming that there is a difference of opinion or uncertainty about value at the starting point. And I guess a lot of these sort of organizations we've spoken about today, there are those uncertainties. So, I think it can really change the direction of a valuation, or give substance to focus the valuation on the most important sort of factors that could influence value.
Thank you very much.
Maybe I can add a little bit to that. I think something that was not shared as well was so the value of intangible assets is also affected by ownership, who owns the assets. So
Correct.
IP or intangible assets under one ownership structure may deliver modest results, yet in the hands of a strategic acquirer with the scale and geographical access, having complementary assets, it can be transformative. So recognizing that best owner value also helps to determine where the real leverage lies. And so valuation is not just merely an exercise in pricing, but also a tool of strategy. And so I think that's an important point that needs to be noted as well.
Thank you, Tim. Thank you, Ian. Now that sort of gives us a lot of clarity. The question now we have reached the segment three of our show today: synergy between valuation and M&A. Now, this is a discussion to all speakers. So now, how anyone can answer that you feel like how accurate intangible asset valuations can tip negotiation leverage.
I think Mr. Lim would be a good candidate to answer that question.
Sure. I think just building on what Tim shared earlier, so when intangible assets are properly valued, they actually fundamentally reshape the negotiation landscape. And as we are seeing, and what we are seeing nowadays is deals are rarely won or lost just on your tangible assets alone, not just based on factories, inventories, or working capital, but most of the real economic value is in the intangibles, your brands, your proprietary technology, your relationships, your data. And having an accurate valuation of these assets, I think, injects more transparency into an area that is typically very subjective. And for the seller, it might mean no longer hiding value simply because intangibles are difficult and hard to measure. For the buyer, it means providing clarity around what is being acquired, ensuring capital is allocated to assets that deliver sustainable returns. And it's bridging the gap of this asymmetry of information, which so often is an important part of M&A negotiations. And that begins to dissolve when both parties can start to point out these assets and backed by defensible, evidence-backed financial models.
Okay, thank you. Now, complementing that answer, Ian, mitigating risk of post-acquisition value erosion. Now, how do we go about doing that?
Um, I think the true challenge is not just striking the right price. It is also about ensuring that the value survives after the deal.
Right.
This, and I think many acquisitions like falter because buyers always secure these assets but fail to preserve or integrate them effectively into their business, and this results in what we call value erosion. This results in customer churn, uh, your important talents, human capital, they are demotivated and starts to leave the company, the loss of that competitive edge. And in essence, the acquirer, and in essence, these could be lost if you don't know how to maintain these assets. I think Tim might want to add more onto that, but having a deep understanding of what your assets are, what those risks are currently with these assets, and how to protect these assets would be an important consideration in the process. How do you manage these assets better as well as its risks in the foreseeable future?
I think that's a great answer, yeah. And I think the one thing I'd add perhaps is, we spoke about that value mapping and understanding the cogs, but in an acquisition, you almost need to understand the two value maps, both the acquirer and the target company. And sometimes it's a clumsy integration of two kind of mismatched business models that can actually kind of upset the workings of the acquired assets. So you're almost killing the golden goose by not understanding the characteristics of those kind of really crucial intangibles that were pivotal to its success. So it gets back to one word, I'd say, visibility, and then care. Two, visibility, and then the care and the integration.
Okay, gentlemen, we have come to the end of our show. Thank you very much. We have got a lot of deep insights now. Valuing what you can't touch is now central to building sustainable corporate growth. And once again, I would like to congratulate Maxwell Rand Inc. and Quantum Valuations collaboration as a paradigm shift, because now you have got a company that has sharing the knowledge-based company that is collaborating with a valuer that has never happened before. And in today's hybrid economy, mastering both intangible assets and digital innovation is no longer optional. It's a decisive advantage. Quantum brings unmatched expertise in valuing and monetizing intangible assets, while Maxwell Rand delivers digital foresight. AI mastery, digital asset strategies, and leapfrog technology advantages to turn value into market leadership. We are entering what analysts call the golden age of AI, a period between 2030 and 2040 when AI will not only automate processes but also design, predict, and innovate at unprecedented scale. McKinsey projects AI could add up to 25.6 trillion to the global economy by 2040, driving productivity, new business models, and entirely new asset classes. This shift will fundamentally redefine how valuations are calculated. AI generated intellectual property, algorithms, and data sets will become high value intangible assets. Digital platforms will hold greater market weight than many traditional industries. Valuations will increasingly measure digital and AI driven capability as a core determinant of enterprise worth. By 2040, the digital economy supercharged by AI will eclipse the traditional economy as the dominant driver of global GDP. Through their combined expertise, Maxwell Rand Inc. and Quantum are not just preparing companies for this era, they are positioning them to lead it, blending valuation precision with technology led execution to deliver sustainable, scalable growth in the age where AI is the ultimate accelerator. Thank you very much, gentlemen. It was a pleasure having both of you all in the show. And good night to our audience, and join us again for our Tech Talk.
Thank you.